everyone. Thank you all for joining us today for our webinar on the ownership and management of small multifamily rental properties. My name is Shazia Manji, and I'm a research associate with the Turner Center for Housing Innovation at UC Berkeley. I'm going to share some key findings from our newly published report, which provides a window into small multifamily rental properties in the United States, including owner characteristics, financial challenges, and property management practices. The report was a team effort and came together with generous funding from Fannie Mae and the input of property owners across the country who were willing to share their experiences with us. I'm joined by a wonderful panel of expert researchers and practitioners, all of whom work in various capacities to support this part of our rental stock, and who will be sharing their insights on the challenges and opportunities for preserving affordability, supporting habitability, and ensuring the financial viability of these properties. Just a little housekeeping before we get started. If you haven't had a chance to read our new report, we're going to include the link to that in the chat. We will also be recording the webinar, and it will be available to view on our website. We will also be reserving some time during the event for audience question and answer. If you have questions for our panelists or about the report, please share them with us by typing them into the Zoom Q&A feature. So please send over your questions and we'll do our best to answer as many of those as we can during today's webinar. All right, so let's get into it. First, a little bit of background. Our report focuses specifically on the small multifamily rentals or properties with between 5 and 49 units. These properties are an important source of lower cost housing across the country. They make up 17% of our rental stock, which is 8.2 million units across 493,000 properties, and they tend to rent for less than units in larger multifamily properties of similar age and quality. Properties with 5 units or more are also considered commercial and are financed with different loan products than 1 to 4 unit rentals. Though they are recognized as an important source of affordable rental units, research on this part of the market is slim relative to smaller properties like duplexes, which are often owned by small-scale mom-and-pop type of landlords, and the largely corporate-owned large multifamily sector. For example, there's a lot we don't know about who owns these properties and their financial motivations. We don't know why landlords in these properties charge lower rents. How do their financial motivations inform how they manage their properties, including how they choose tenants and invest time and money into upkeep and repairs? Owners in these properties are also less likely to be members of national or local property owner associations, which means that their experiences and perspectives are not well represented in policy conversations. But for policymakers and practitioners who are working to stem the loss of affordable units, more information about this part of the stock can help inform strategies for preservation. So to help address some of these gaps, in 2022, we fielded a nationwide online survey of owners and managers of 5 to 49 unit rental properties. Our analysis relies on 764 survey responses and is designed to represent by size the national distribution of these properties as reported by the Census Bureau's 2021 Rental Housing Finance Survey. The survey covered a variety of topics and asked owners about a specific property within their portfolio. Because we fielded the survey during the summer of 2022, some of the information we collected reflects owner experiences during the COVID-19 pandemic. All right, so let's get into findings. One key finding from our report is that most small multifamily rentals were owned by individuals, although they often established an LLC to hold their property. The chart on this slide shows the share of properties by their ownership structure. A third of properties were held directly by one or more individuals, and another 38% are owned by an LLC where the majority owner was an individual. About 9% were owned by an LLC that was in turn owned by a corporate entity, and another 8% were held by a corporate owner directly without the use of an LLC. Data from the Rental Housing Finance Survey shows that over time, this share of small multifamily properties owned by non-individuals has increased. Our analysis suggests that this pattern is at least in part driven by an increase in individual owners establishing LLCs to hold their property rather than true corporate consolidation. We also learned that owners are really a mix of professional and part-time property owners. 25% of properties were owned by corporate entities or individuals who describe themselves as full-time investors. About a third were owned by retirees, and another 36 were owned by individuals who have another job, full or part-time, outside of property investment. The majority of properties were purchased primarily for the income that they would generate or potential capital gains. Many owners also reported that their property was part of their retirement income or their longer-term plans for their family's financial security. 16% of properties were purchased at least in part with the intent to provide affordable housing in the community. We also learned that the median owner age was in the mid-60s and that 45% of properties were being managed entirely by the owner. The rest were being managed with the support of a management company or someone like a building superintendent. So moving on to tenant screening and selection, we know that landlords have many different options when it comes to screening tenants, from seeking proof of income and employment, interviews with the applicant, credit and background checks, and the use of third-party screening tools. Our analysis shows that owners use a variety of and multiple methods to select tenants. However, credit checks stood out among them. Owners in about 2/3 of properties reported running a credit check as part of the application process, and when asked which method was the most important, credit check was the most frequent response. And this was true across owners with small portfolios and those with larger ones. While running a credit check was universally important among owners, we did also find variation in the importance of other methods by portfolio size. Personal interviews were more important among smaller owners, while online screening tools were more important among those with large portfolios. This is consistent with what we know from existing research that tells us that small-scale landlords tend to rely more on informal and subjective methods to screen tenants, while large corporate owners tend to favor the use of third-party screening tools that bring together data on an applicant's income, credit, eviction court records, etc., to rate applicants. While bias and discrimination can show up in different ways across these approaches, small landlords may be more willing to overlook a prior eviction or low credit if they have a positive interaction with the applicant. Our analysis confirms that below market rents are common in this part of the stock. We were able to assess this in a couple of different ways. First, we asked owners to characterize the rent levels in the property surveyed. In nearly half of properties, owners reported that most or all of their units rent below market. Another 25% reported a mix of above and below market rate units. We also asked owners to provide the highest and lowest rents charged in the property surveyed, and we looked at those rents in relation to local conditions and also found that median rents were below market. When asked why they kept the rents below market, the most common response given was to prevent turnover of tenants and to ensure that the tenant could continue to pay the rent consistently. In fact, when asked about the rate of rent increases for continuing tenants, about 1/3 of properties reported that they rarely changed their rents at all. About 40% of properties cited some other reason for keeping the rents low, and we found that the write-in response to this question most often reflected policy restrictions on rent increases, like rent control and stabilization laws, or rent freezes that were put in place during the COVID-19 pandemic that were in effect when the survey was administered. Some participants shared that the low rents reflected the specific condition of the property, like small or older units or maintenance needs, or other subsidy program regulations that apply to their units. So we know that the economic impacts of COVID-19 hit renters particularly hard, especially lower income and Black and Hispanic renters. Most small multifamily properties saw an increase in late rent payments during the pandemic, and in some cases, this posed moderate or severe cash flow problems for owners in this part of the stock. The chart on this slide shows the most common ways that landlords responded to unpaid rent, broken down by the owner's portfolio size. And you can see here that larger owners were more likely to take any of these actions in order to help recoup that loss in rental income, whether that action was to pursue or provide some kind of support, like directing the tenant to rental assistance or offering a payment plan, or to take some kind of legal action, like initiating eviction or collection proceedings. Overall, we found that owners in 45% of properties applied for rental assistance directly or assisted their tenants in applying for assistance. We also found that evictions were pursued in about 1/3 of properties, specifically as a response to late rent. We also asked owners a series of questions about finances and financial performance, and found that many properties show signs of substantial problems in this area. For example, 1 in 5 properties had been turned down for financing at some point in the past. And as mentioned in the previous slide, COVID-19 was also a source of financial stress for many small multifamily property owners. 1 in 4, or 25% of properties, reported no profit during the year previous. 28% of properties experienced moderate to severe cash flow problems as a result of unpaid rent during the pandemic. We also asked owners to describe the quality of their property and their approach to maintenance. And we found that most properties were in excellent or good condition according to their owners. However, 28% of properties were reported to be in fair or poor condition with substantial improvements needed now or within the next few years. Postponing maintenance of some kind, whether for minor issues or more substantial ones, was reported in 25% of properties. Owners of properties facing serious cash flow problems were more likely to report deferring property maintenance. Newer properties and those charging higher rents were more likely to be in better condition compared to units in older buildings or those that charged lower rents. These numbers highlight some of the core challenges with respect to both affordability and habitability. And as part of the stock, small multifamily properties are on average older than large multifamily ones. Many of them need renovation and they need capital to make these improvements. Coming out of the pandemic, especially in properties with limited cash flow, there's potential for housing quality issues to worsen. So just a couple of final reflections before I hand it off to our panel. Generally, our analysis shows that small multifamily owners operate in a sort of middle space in terms of professionalism between small rental properties that are often owned by mom and pop type of landlords and the more business-oriented large multifamily sector. The results of our survey also confirm that these properties are an important source of lower cost housing. Most properties provide below market rate units due to some combination of management choices and rent stabilization laws. But at the same time, the financial challenges facing owners of these properties threatens to exacerbate quality concerns and limit affordability, particularly in older buildings and in those held by smaller owners who may be more inclined to sell when faced with steep arrears. While our research is a first step towards understanding this part of the market, there's also a lot that can still be learned. For example, research looking at tenant experiences in these properties is crucial. Also, additional reporting requirements for landlords could really help researchers better understand rental markets and how owners respond to local and state regulatory environments, which differ substantially between geographies. I am going to stop there. I hope you all have found this presentation useful. If you're interested in exploring the full report, you can access that at the link in the chat or by heading over to the Turner Center website. And with that, I am going to hand us over to Dr. Phil Garboden, Associate Professor at the Crown Family School of Social Work, Policy, and Practice at the University of Chicago, who will be moderating our panel. Phil has spent the last 10 years engaging with landlords and property managers around issues of investment, management, screening, and other topics. He's currently pulling this research together in a book co-authored by Eva Rosen entitled American Landlord. Phil?
Wonderful. Thank you, Shazia, for the introduction and for the fascinating report and presentation. As you mentioned, this is a sector in the landlording world that gets very little scrutiny and very little data collected on it. So it was fascinating to fill in those gaps. I want to, before I introduce the panel, remind folks that if you have questions that you'd like me to answer, to ask of the panelists, please put them in the Q&A. We have some time budgeted at the end specifically for audience questions. So we've assembled a panel of folks with really exciting range of expertise on this topic. And next up, I'll be giving each person a chance to introduce themselves and their work. But briefly, we have Nat Decker, who's the lead research economist at Fannie Mae. He's a Turner Center affiliate, and as you may have noticed, a co-author on the report. We have Ruby Bolaria Shifrin. She's Director of Community at the Chan Zuckerberg Initiative, and she's going to be talking about a really interesting pilot that they've introduced to help stabilize this kind of stock. And we have Priya Jayachandran, who's the CEO of the National Housing Trust and a Turner Center board member. So before we get into specific questions, it would be great if we could go around the room and just introduce yourself and your work. And I'll start with Nat. If you wouldn't mind giving a few minutes on who you are.
Sure, thank you. Thank you, Phil. Yeah, my name's Nat Decker. I'm a research economist here at Fannie Mae. Prior to that, I was a postdoc at the Turner Center for Housing Innovation. And as Phil mentioned, I'm a co-author on the report. This was sponsored by Fannie Mae for a number of reasons. Fannie Mae is very active in this part of the market, acquiring loans backed by small multifamily properties, both because it is, part of the mission, both sort of mission-wise and business-wise for Fannie Mae, and also because there is a statutory obligation for both Fannie and Freddie to acquire to have a certain percentage of the loans that they acquire during the course of the year be backed by what are called affordable small multifamily. So these are properties that have rents below, that are affordable to low-income families, and have between 5 and 50 units to them. And so because of that, there's a lot of interest here about what more can we do to support this part of the stock. And it's a challenge to figure out what that is, because as already been mentioned, this is a hard part of the market to get insights into. The larger multifamily properties tend to be held by owners who are very, very large themselves, easy to identify, easy to talk to the people in charge, and there really aren't that many very large apartment operators out there. Whereas when you look at the small part of the stock, ownership is much more fragmented, and there are thousands and thousands of owners there. And it's not a matter of talking to the large trade associations for apartment owners either, because they're small owners are frequently not members of them. And so that's a big part of the reason that we chose to do a survey here, and a big part of the reason that we're really excited to be able to share these findings a little more broadly, because we're certainly not the people who are interested in this part of the stock. And it also provides us with a means to get at our mission too, by specifically focusing on the naturally occurring affordability that you more often see in this part of the stock, as opposed to larger new construction properties. So very interested to very happy that the report is out there, and really interested to talk about it more a little bit later on.
Wonderful. Thank you, Nat. Up next, Priya, would you like to introduce yourself?
Thanks, Phil. I'm Priya Jayachandran. I lead a nearly 40-year-old nonprofit, National Housing Trust. Despite our national name, we're both national and local, and we work largely on affordable housing preservation. We work through 5 levers, so to speak: policy, advocacy, and innovation, real estate development and ownership, lending through a CDFI platform, resident services, and energy solutions, largely community and rooftop solar for the benefit of affordable housing residents. Historically, for most of that 40 years, we've tended to focus on larger multifamily buildings and developments. That's most of what we own. It tends to be above 50-unit buildings. It's most of the development we support with our financing, and it's a lot of our policy work. But about 5 years ago, we started to think more actively about small buildings, really compelled by the data that small buildings, those Shazia talked about, those 5 to 49 units, represent over 50% of the affordable housing stock writ large, and that it was a space that doesn't often get talked about. And candidly, our own real estate development and asset management colleagues really struggle with that stock, and thinking about how could we become more supportive and think about some of the obstacles that prevent us from getting involved, and how could we be part of those solutions. So we've done a couple things, including partner with a couple other organizations here in DC to launch or run a small buildings initiative, really looking at small building preservation in the district. And one of the big takeaways that I've learned is that really local dynamics at play, and that solutions in one market may be different than solutions in another market. Here in DC, our dynamic is that we're a gentrifying city, gentrifying neighborhoods, and a lot of this stock is vulnerable to people wanting to come in and buy it up, potentially demolish it, and develop greater density on those buildings. You may have some of those mom and pop owners that Shazia and the research talks about. They don't have restrictions. They don't want restrictions. And to a certain degree, gentrification may be a good thing from them from an estate planning perspective. They stand to benefit. The challenge is from an affordable housing preservation, which from a wealth creation, it may be a good thing. We're focused, our primary mission is affordable housing preservation. And so how do we keep that housing affordable? And you can come back to that, Phil, the Q&A, but I think that that's what we've been grappling with. And I'd say it is one of the thornier challenges in the affordable housing sector. And because of the size, and particularly in gentrifying markets, because of price points and a lot of competing social priorities, including wealth creation and affordability, which in certain instances are at odds with one another.
Wonderful, thank you. And yeah, I have follow-up questions, but before that, let's move on to Ruby and hear about the Chan Zuckerberg Initiative's work in this area.
Yeah, hi. So Ruby Bolaria Shifrin, and I head up the community team here at CZI, which focuses on housing affordability, economic mobility, and inclusion, and some kind of place-based local work. So our work in this space, our focus on housing affordability has been really about supporting the 3 Ps of production, preservation, and protection. And frankly, most of the work has actually been on the production and protection side. And it was really COVID that drove us more to think deeply about preservation. We saw how the lack of rental payments put pressure on these mom and pop owners, particularly those with a mortgage, to sell to larger investors in private equity who would move the building up market or convert to condos. These buildings are the kind of value add, right? NOAA properties. So they're the most at risk to this inflow of opportunistic capital seeking to acquire these distressed assets. And so in that type of setting, similar to what Priya was talking about, there could be an upside to gentrification, but a lot of times these owners that are selling don't know exactly even how to price these buildings. And so they might not actually be maximizing their benefit in this too. In addition, the loss of that property to a kind of private equity or large corporate investor oftentimes results in the displacement of those current tenants. And so we have this situation where we saw that both renters and small property owners would slide down the socioeconomic ladder together potentially. And it was also painfully clear that there wasn't enough resources or capacity to pursue a full acquisition strategy, right? Meaning, acquiring properties for nonprofit ownership. So we wanted something that could meet the moment more quickly with fewer resources and still lead to better outcomes for tenants and owners. We wanted to specifically focus on small multifamily owners. Urban Institute actually during this time had put together this working group. So a lot of the research that we had was kind of coming out of that. Now with this Turner Center report, I think a lot of those same sentiments and learnings are echoed actually and kind of given more validity, which is great. But we were looking specifically at under 20 unit buildings, owners that owned fewer than 20 units, because it seemed that was also the concentration of BIPOC locally based owners. So if we want to talk about wealth generation and keeping it in the community, that was also kind of a key component for us. So in April of 2021, we partnered with CRCD, a local nonprofit, and enterprise community partners to launch this Los Angeles rental owner collaborative. And LA rose to the top for a few reasons. One is we wanted a place that was either experiencing gentrification or that was imminent gentrification was kind of happening. We wanted a place that had an already existing CBO capacity, so that we can kind of hit the ground running and have that trust built too in a way. And we wanted a place where there was already other funder support so that we wouldn't do this alone. So we actually were able to work with 6 other funders in the LA area. Additionally, we developed a parcel tool to kind of look at all of this stuff, and LA rose to the top. I mean, talk about in California in general, where you have zoning restrictions that make it really hard to build anything above 5-unit buildings. A lot of times, most of our stock kind of falls in that arena. And in Los Angeles County, about 80% of the multifamily housing stock falls under the NOAA category, and is this affordable housing stock. So it felt also like this is the #1 way low-income people get housed. It's not subsidized housing, right? It's this housing stock. So and also the other thing for folks that don't know South LA very well, it's an area that was previously Black dominated. Now it's Latino dominated area, but a lot of the buildings actually are the ownership, especially the local ownership, is still Black owned. And so we wanted to support local Black ownership and the existing Latino population there. And we consider that kind of a big win, which I can get into later, some of the things that came out of that. But just one last thing is I'll say that we kind of phased this into 3 phases. Phase 1 was about stabilizing owners and their tenants through rental arrears, technical support, so an ambassador program to help navigate through government relief and rental services. And then we're also wanted to build an owner collaborative. So the number one reason that we saw these small owners were selling was due to deferred maintenance issues and property management. And they're also not benefiting from the economies of scale that institutional larger landlords have. So how do we use almost like a bid, like a business improvement district model, for these small owners to come together and unlock those economies of scale, whether that's through shared contracting services, pooled insurance, property management, among others. And all the while kind of minimizing harm on the tenants. I think one of the critiques you could definitely say with this program is that it was very much an owner-focused program. Most of these buildings either had a deed restriction or, similar to what the findings were in the report, the owners knew that they were selling below market and were fine with it. They just wanted to make sure that they could cover their expenses and make theirs. And then they were fine with giving back to their own community. 63% of the owners we worked with lived in South LA. So these are folks also who are deeply kind of rooted in their community. And so it's interesting to see some of the findings in the report too, of like the motivations, because I think that's also reflected in folks knowing, kind of making that trade-off consciously, which would be unheard of for a large corporate owner, right? Like you're not maximizing profits and squeezing everything you can out of these tenants. So I think there's something there to kind of think more deeply on. It still is hard and there's a lot of challenges that we can get into, but I think one of the things that's been interesting in this is how do we create some solidarity here, think about not all landlords are evil, while also recognizing not all small landlords are great either. But it's, it's a mixed bag, but there's just so much undiscovered in this slice of the market, I think, that we're kind of starting to dig into more.
Terrific, terrific. Lots of, I think, through threads through everything that was said. Start out with a question for Nat. And, as you heard from both Priya and Ruby, one of the main challenges of the stock is financial vulnerability. And I know when you write a report like this, a lot of sort of really interesting data gets left on the cutting room floor. So I'm curious to hear a bit more about the financial health of the properties that you surveyed, and with the caveat, of course, it's self-reported data, and particularly about the sources of financial stress that the owners were expressing to you.
Yeah, so that was a big part of what Fannie Mae was interested in here, and we found something that is similar to what's been noticed in prior studies of this stock. The last there was a major study done back in the 90s, and one of the big findings from that was that a lot of the smaller multifamily properties did not, have a profit at all. They didn't have any substantial, what's called net operating income, which is the amount of income that is left over after you've paid for all of your operating expenses, like janitorial service, any replacements to building systems, property maintenance, insurance, and that sort of thing. And we found that in many cases that is still the case here. You have about 25% of properties in this size category that either, effectively break even, have, little to no net operating income, or actually are being run at a loss. So there's a negative net operating income there. And that, among other things, that means that the property is basically unfinanceable in a conventional way. It doesn't have any money left over to support any debt. And that's a big problem if the building is aging and needs substantial capital improvements. Usually that's done in the form of getting a mortgage. You do big upgrades to the building, structural things, improving the HVAC systems and other building systems, doing energy efficiency improvements and all of that sort of thing. So that's why it's important to have a profit for for a building. In terms of why a lot of these buildings were not profitable, it was a range of reasons, and it's difficult a lot of times to discern the role of good management and good operations, and separate that out from market conditions. So it's hard to say if you're looking at the rent revenue for a property and it's just not big enough, is that because the owner is setting rents lower than they should be? That's good for the tenant, but that may not be good for the long-term financial health of the building. Or is it because they're setting rents at what the demand is in that particular neighborhood? It's sometimes hard to discern those sorts of things. Another issue when we delved a little bit more deeply into what's going on here are relatively high per unit operating expenses. One of the things that really stood out to us was that there was a pretty strong correlation in the level of management fee. So this is the amount of money that the owner pays to a management company or that they pay to on-site management. That level of expense was very strongly correlated with whether the building was unprofitable or did not turn a profit. And some of those fees sometimes amounted to 15% or more of rental income. That's relatively high in the context of multifamily housing. Another thing which was unsurprising here is that buildings that house mostly low-income tenants were much more likely to be unprofitable than those that housed higher-income tenants. It shows that that while there is a lot of naturally occurring affordable housing here, as Priya and Ruby have mentioned already, that doesn't mean that it is that this is necessarily financially stable or that it is profitable or anything like that to be managing properties in this way. It's a challenge in many cases, and it's a challenge that maybe there's some room for improvement here, by improving operations, reducing the levels of vacancy, which we also found in some properties were disturbingly high, again 15% or more in some cases. But there are fundamental facts, there are fundamental issues with the running these properties at the income level that they're at that make it tricky in the tricky, at least from a conventional financing perspective.
That's terrific, and yeah, I very much appreciated the point that everyone's a good manager in a high-end hot housing market, right? It's much easier to manage certain properties than others. So turning to from this vulnerability to something Priya mentioned in her introduction, you talked about this issue of owners facing gentrification pressure, and there seems like there's real issues for you as a mission-driven entity when you're competing not just with abandonment and deterioration, but with developers who are looking to capture a pretty significant financial windfall in a market like DC, and I imagine many cities in California as well. So I'm curious about what strategies you use both to identify the owners that it's worthwhile to make a pitch to, and then how you sort of convince folks to pursue this strategy of preservation rather than demolition and putting up a new luxury building.
Yeah, first I realized I forgot to wave my Turner flag. I am a proud board member of Turner Labs, which is the parallel nonprofit to the Turner Center. But to your question, let me also say at the outset, we are really at the beginning of this work. I don't want to misrepresent. I think we are the motivation for the initiative and our partnership with two other groups was that between 2006 and 2017, DC lost 18,300 small unsubsidized units, it's roughly 5% of the stock. It's probably not permanently lost because, as we were talking about, maybe replaced, but what's lost is that affordable housing opportunity, because rarely is it replaced with affordable housing. It's often upmarketed. And goes without saying, I mean, we're about affordable housing preservation, but small units tend to be less expensive to preserve, obviously, than new construction, and the environmental impact of preserving. To your question, how do you do it in a market with rising prices? DC gets a lot of attention and credit for our TOPA law, the Tenant Opportunity to Purchase Act, and we have a parallel law, DOPA, the District Opportunity to Purchase Act, and those are really powerful tools. And on our advocacy side, we support other jurisdictions adopting them. But what many people don't understand is that you still have to match the market price for that building. So what triggers TOPA or DOPA is a market rate bid on a building. So it opens the door to preservation because the tenants or the city has the option to match that bid. But if it was a high bid in the first place, then you have to come up with the resources to match that bid. I'll give an example of what I think is a success story, but also I think underscores some of the challenges and the timeline involved. Because those prices tend to be high, even for smaller buildings, folks using TOPA will often partner with another developer, often nonprofits, but sometimes for-profits, and assign their TOPA rights. And those partners, like us, we've partnered with 12 tenant associations, will often use the low-income housing tax credit to preserve that building. I imagine some people will roll their eyes and, well, I thought this was about unsubsidized housing. The challenge is that it's hard to come up with that purchase price and particularly fund repairs that may be needed, and the low-income housing tax credit can allow you to do it. The residents don't necessarily become owners, but they are guaranteed that the housing remains affordable. That said, one of our first partnerships with using TOPA and residents was in 2002, a community called Meridian Manor in Washington, D.C. And for those familiar with LIHTC and all of its nuances, there's the ROFR in LIHTC, which is the right of first refusal at the end of the 15-year compliance period. And back in 2002, we granted that ROFR to the residents. Fast forward 15 plus years, now 2024, that community is out of its initial compliance, and the residents are in fact purchasing the building from us. And we are remaining in as a fee developer. They're recapitalizing it again because it needs work 20 years later, but they're now becoming owners. And why I think that's illustrative is it's a long game. That was 2002 and it's 2022. And we are creating wealth for them. We are preserving it. Did they become owners those first 15 to 20 years? No. Was it hard and did it take a long time? Yes. And I say that because I do think that there are no quick solutions, particularly with this stock. And I think sometimes in this moment of our housing crisis and a focus on wealth creation and racial equity, that people are looking for fast solutions. And, I'm all for them if we can find them. I haven't found any. And I do think that Meridian Manor is an example of that. It was preservation, it was wealth creation, and it took 22 years.
Yes, I think the idea that something could happen in this particular sector of the stock, overnight is certainly a challenge. So you mentioned wealth creation, and so I wanted to turn to Ruby's project. And I think that the thing that was really interesting is how you make this explicit goal of keeping rental income, housing wealth within the communities that you're focused, right? And we so often think of landlording as an extractive practice, right, that takes rents from Black and Latinx communities and transitions them into higher income white spaces. So I'm wondering just to hear more of your thoughts and how successful you feel the project was at that double goal of keeping rents reasonable, but also doing so in a way that allows for wealth creation in communities that have been deprived of opportunities for wealth creation for so long.
Yeah, for sure. So the pilot worked with 52 owners representing about just under 200 units. 70% of the owners stated that LROC helped keep their tenants housed, and 50% said that it helped them not sell their properties. None of them wanted to sell their properties initially. 2 properties were sold, and the owners did notify the CBO partner before selling. So part of this too was potentially is this kind of like a bridge for when those opportunities do arise, that we can keep those units affordable. 92% of the owners are BIPOC, 56% are female. I was actually surprised how many female owned buildings there were. 65% identified as Black, 20% as Latino. And as I was mentioning before, 63% said they currently live in South Los Angeles. And so one of the things I think that we're really proud of is that we were able to reach those hard to reach owners and their tenants, right? These are the folks that traditionally don't get access to the benefits that are coming in. Like I think about also PPP loans and all of this stuff where you hear of all these great government services that are coming in, but you have to have, it feels like an army of lawyers to be able to get it, and to understand how to, fill out a million different forms and resources. Like one example, going back to what Nate was talking about, we're working on how do we lower things like operating costs and other ways to maximize their revenue on this building without necessarily jacking up rents. And one of the things that we have is the welfare tax exemption, which does work for the majority of these buildings because they're rented at 80% or below AMI. However, figuring that out, there's a lot of requirements, there's a lot of admin. So we haven't really seen that many folks utilize it. But this is a way where kind of public-private partnerships, I think, could have a much bigger role in stabilizing this housing stock. Another example is that we tried to work with the city of LA and DWP to access their energy retrofit dollars. So there's actually a lot of pots of government dollars to help with deferred maintenance and to bring these buildings up to either code or even more so thinking about the energy retrofitting, right, that we need to happen, especially now. I'm hopeful with things like the IRA that passed. What other opportunities are there? It ended up not working for a couple of reasons. One is that they wanted to focus on larger buildings, which probably makes sense from a scale point of view, but is there an opportunity also to help with smaller buildings is kind of a question. And there was a lot of paperwork and a lot of challenges that these owners needed some hand-holding on, which we were willing to provide, but it was still ended up being a very onerous thing. So even if we were able to make that work here, how do you scale something like that? How do you replicate that? And so I think thinking about the role of an ambassador, a QB, something like that is a good interim. I mean, obviously a long-term great solution is to stop focusing so much on fraud and maybe focus more on getting benefits and the outcome out there. That was one of the driving factors that we had is let's make this as low barrier as possible, right, to access these benefits. And I think that worked out well also in terms of trust building, where a lot of these owners were fearful and did not have a lot of trust in either government services or anyone trying to help them out. And I think that now, over the course of 2-3 years, we've been able to build a lot of that trust, and they're valuing participating collectively and figuring out, how do we create our own fund, where we have a revolving fund where they can tap into for things like repairs or emergency rental assistance for their tenants. And how do we get that to be a little bit more self-sustaining? Additionally, how do we advocate? The owners are talking about how they advocate for themselves because the apartment association and the existing lobbies do not represent their best interests. and oftentimes are not aligned with them, but there's nobody else. And so how do we think about the role of these smaller owners who, frankly, a lot of them did see themselves as housing providers, and kind of part of that community. And so it was actually really interesting. We did a bunch of focus groups, and we did them and we mixed them in a lot of different ways. And it was interesting that most of the BIPOC focus groups felt much more affinity and kinship to their community and offering being a housing provider and not seeing their building only as a source of income. So I think there's also something there in like the idea of communities helping each other in the absence of other help, basically. So that type of entrepreneurial nature is helpful, but it also kind of gets me all fired up that like a lot of the government programs and services that we have that are meant to help these folks rarely reach them. So how do we bridge that gap? And I think there is opportunity and learnings that we've had on how to do that.
That's thank you. That's fascinating. We think a lot, or at least we here in the social work school, we think a lot about administrative burden and the hoops that we make low-income folks jump through to get benefits, and it's sort of always based on this, specter of potential fraud that must be avoided at any cost. But when we talk about supply side support programs, whether it's the low-income housing tax credit or these types of local programs, we create enormous barriers there as well, which means certain types of landlords can access them, and certain type of landlords simply don't have the capacity to do that, which drives investment patterns and preservation patterns across. So that's a fascinating point. I wanted to shift now to a few questions from the audience. One of the questions that came up, and I think, Nat, it would be great for you if you could answer this, start off answering this, but I'd love to hear from Priya and Ruby as well, is that we're talking a lot about preservation today, but there seems to be something special about buildings of this size that makes them a very powerful source of unsubsidized affordable housing. I mean, I know the literature is not finalized in this, but they seem to sort of hold affordability for longer, less vulnerable to redevelopment, than you would see in the large multifamily sector. And of course, single family homes, have this fluidity into and out of home ownership that can occur to make gentrification fairly easy. So there's something special about buildings of this size, and I'm wondering if from the survey research or your work at Fannie Mae, what's being thought of in terms of producing more, mid-size, small multifamily rental housing in the country?
Yeah, it's a really good question. One of the other motivating facts here was that over time there has been, it's hard to measure for data reasons that we can get into. It appears as though the construction of multifamily properties has tended more and more towards larger multifamily properties over the past many decades, really. And so you find when you look at the nation's housing stock now that as we mentioned before, this part of the stock looks older, and it's because it hasn't been added to as much over the past years. I think that there are various explanations for why that has occurred. Properties are financed in a different way. The construction industry is somewhat different now than it is in the past. From Fannie Mae's perspective, it's a little tricky because we don't do construction financing. We only purchase loans that are on properties that are, it's referred to as stabilized. I mean, the property is in place and most of the tenants are in place too. So we don't have that many levers, unfortunately, that we can pull that deal with generation. However, because we do buy loans buy permanent loans, we can provide a takeout to construction loans there, and that's something that we had in mind when we were looking at the study and looking at the results too. It's I'm not. I wish I had a great answer to this one, because I do think that it is that it's important to think about generation in addition to preservation. But I'm not really sure what we can do, or really what the broader market can do to advance generation in this part of the stock. one of the things that I do think is promising here is the increased attention that's been attracted to what's often referred to as missing middle types of properties. And so, these are defined in different ways, but the idea is that in a lot of infill sites, you can, build properties that are not high rises, but are sort of mid-rise properties that, have the sort of characteristics that, we've been talking about. And those can be facilitated through various zoning reforms, usually at the local level, but sometimes at the state level. And there are some places where you have seen, substantial generation of that kind of property through those kinds of land use reform methods. But again, that's not something that Fannie Mae has much direct control over.
Yes, thank you so much for that. And yeah, I think in jurisdictions where large multifamily might be a non-starter politically, oftentimes small multifamily, if that's the amount of density you could get through, then as the not only more housing, but also in this particular subsector that seems to be so valuable. So depending how long your answers are, this may or may not be a concluding question. But starting with Ruby and Priya, you have pilots in Los Angeles and work done in DC. I think the question that we're seeing a lot in the Q&A is, if you're, well, I should preface this by saying, and both of you described local policies that may or may, whether it's TOPA or other systems that may or may not have been intended as a tool to make this type of preservation happen, but that you're able to leverage for that. So I'm curious, as you think about scaling your work outside the district, outside of the LA pilot, what are sort of key asks that folks on this call should be making at policymakers to facilitate the kinds of interventions that you've been doing? So I don't know who wants to start, Priya or Ruby, but love to hear from all three of you.
I can go real quick because I'm sure Priya will have more on this. But so I think that well, one thing is, and this is kind of echoing what Priya was saying around, there's no silver bullet, and also to think more comprehensively. So one of the biggest, I think, challenges with the TOPA COPA stuff that we've been facing in California is that it's not paired with any kind of financing. And it is really difficult to think about how you're going to finance, the acquisition of a building, especially when you're dealing with folks that maybe have less experience on building acquisition. One of the things that we have is the Partnership for the Bay's Future, which is a fund for the Bay Area. It's gap financing fund. And so when we actually have issued some loans on using TOPA COPA for building acquisitions, and they were snowflakes, like each one is very hard to do. They're customized because we're still figuring it out, right? There's some R&D space that's needed. And if we think about it more as R&D space and some test money, right? And then figure it out, and then it can get scaled by government and other actors, great. But the solutions are coming too piecemeal with like one policy intervention here that's not thinking about the other impacts or things that need to change, whether it's on the financing side or other regulations that's related to it, that would make things a lot easier. And I think another thing too that we discovered on the LROC piece that would be interesting to think about, that's a little less, it's related to policy, but just the digital divide. So Avail was our tech partner on this. Avail's done a lot of work kind of supporting government and research agencies thinking about this sector of DIY landlords. And they, the majority of the owners that we worked with just didn't use that Avail. Avail is a free property management service that they could use to help do a lot of different things, including 10 applications, sourcing folks, dealing with stuff online. And there was folks that just didn't see the value in it, didn't really understand how to use it, needed some help. And that, I think, is an unfortunate thing where it's like, well, one is on the plus side, Avail actually used this as an opportunity to think about how they could build tools that work better for people. And so it helped them embed equity in a different way, which I think is really great. It also exposed what we saw a lot during COVID, right, around this digital divide. And it doesn't serve us to keep that there and to work around people's lack of ability to navigate digitally, right? So how are we also training people up in understanding how to navigate these resources? Are there better ways that we can be communicating information, like texting folks, right? what are some easier ways to get information out there? Because publishing something in a bulletin in a newspaper just like is not the way to do it anymore, right? So I think there's more around that would be interesting to dive into.
Yeah, maybe I'll start with the easy and end with the hard. I think, a couple steps that we think could be helpful are shared asset management and property management service platforms. One of the challenge for bigger, even small to medium-sized owners like us is the asset management and property management of small multifamily. There are some emerging models out there like Joe NYC. And I think that that's a real opportunity. I'd say dedicated funding streams for small buildings. San Francisco has the San Francisco Small Sites Program. So that's the easy. The harder is, I think that the problem that Nat identified, I would argue, is part of a bigger problem. And that is that as a country and as developers, almost no one is developing for unsubsidized new affordable housing today. Everything that is developed on the single family side or on the multifamily side, even if it's small, is for the luxury market. So I'm not going to argue that there isn't small new development in DC. I see these infill buildings, but they're not targeting people who can't afford high rents. And I'd say that that's a systemic problem. We see that on people being dependent on LIHTC is kind of like being dependent on crack. But like you want to get off of it, but for us, there's not really an alternative because there's no funding stream. And I think that the fallacy that we all tell ourselves is that you can do this without subsidy. And I do think that that's the answer that's missing, is that and that's the best use of public policy, I would argue, is to identify a market externality and to solve it. It's not all about, just these market rate funds have to come out. I do think that you're going to have to think about subsidy programs beyond the low-income housing tax credit that try and create and preserve more of this small stock, that it's a different tool than the LIHTC, and that is trying to create and preserve more of that. And I think we have to stop apologizing for that and just banding together and say that's what it's needed.
Thank you. And at the risk of going a few minutes over, Nat, I'd love to hear your policy thought here.
I mean, I think, looking back through the data, especially the production data, you see time periods where you get, a big boost in multifamily stock. There's actually a big boost going on now. It's mostly, exactly as Priya was talking about, large and, higher end. But you also saw a large increase in production when there were, they weren't the sort of subsidies that we're used to now, but in the 70s and 80s, where you had accelerated depreciation, and it paid more to build even smaller multifamily properties, and you didn't necessarily have to get the premium rents on those for it to make financial sense to build those. So I'm not speaking for Fannie Mae here, obviously, but if there is an interest in the generation of moderate cost, decent quality housing of the kind that we're, that this report is, talking about, even though that's the older part of the South, if you're interested in generating that, that's one, sort of proven method by which, this nation has generated.
Wonderful. Well, we are out of time, but thank you to all your panelists. I have about 37 more questions that we didn't get to, but I think that's indicative of how exciting the report and this conversation has been. So for those in the audience, I know this presentation will be posted on the Turner Center website and as already is the full report that Nat and Shazia wrote. So look forward to that, and I'm sure continue this conversation in many other places going forward.